Welcome back to the Deep Dive. Happy Friday. It is January 16th, 2026, and we are about to jump into, well, what might be the most confusing and honestly the most important financial puzzle in AI right now.
It's good to be here. And yeah, this isn't your typical tech deep dive. This is really a deep dive into corporate law and existential risk, all wrapped up in a potential IPO.
Absolutely. So our mission today is to really unpack the insane complexity around the potential IPO of OpenAI. We're trying to get our heads around this tension, when a company is valued at over $500 billion.
A decacorn many times over.
Right. But it's also burning cash at a rate that is just, it's completely unprecedented. It's a total paradox.
That paradox is the whole story. I mean, the core question here really is, can traditional shareholder capitalism, which, demands profit and growth every quarter,
Right, that quarterly pressure.
can that system even coexist with a company whose legal foundational mission is to put AGI safety above profit?
And the sources say the technical readiness is there. They're looking at maybe late 2026, early 27 for a listing. But you're right, the structure they've built is, it feels designed to be hostile to a traditional investor.
It is. This IPO, if it happens, it's a test case. It's a referendum on the whole setup. We have to look at this company as a totally new asset class.
Okay, so let's unpack this. Let's start with what some are calling the architectural wall they've built. That transformation back in late 2025, it wasn't about making things simpler.
No, not at all. It was a strategic move to lock in the mission. They moved the whole operating company into a public benefit corporation, a PBC, structured in Delaware.
And that PBC mandate, that's the key thing for any investor to understand.
Right. It's the single most important detail. It means the board of directors has this complex fiduciary duty. They have to balance three different and often competing things.
Okay, what are they?
First, the financial interests of the shareholders. Second, the interests of general stakeholders, which in their case is basically humanity. And third, their specific public mission.
And that mission is stated very clearly. Assure that the AGI benefits all humanity.
When you say fiduciary duty, this isn't like a friendly suggestion.
Not at all. It's a legal requirement. And this structure, it creates what analysts are calling the Muralla China, the Great Wall.
A wall between what and what?
Between economic ownership and actual political control. The original nonprofit, the OpenAI Foundation, keeps absolute political control over the whole thing, the OpenAI Group, PBC.
Okay, so walk me through what that means in practice.
It means the foundation has, maybe a 26% economic stake, a minority stake, but they have the exclusive power to appoint and remove the majority of the PBC board.
Wow.
And look at the money. Microsoft has a 27% stake. That's worth around $135 billion today.
Right.
But all that money, it doesn't buy them control. Their voice is legally neutered on the big strategic questions.
So if I'm a shareholder, how does that actually affect my investment? Well, that's the whole so what of governance risk. Because of that mission, the board is legally obligated to prioritize AGI safety. They not only can destroy shareholder value,
For example, by stopping a really profitable product if it's deemed too risky.
exactly. They not only can do that, they must do that if their safety theory requires it.
That's so different from other PVCs,
Yeah.
You have companies focused on education or ethical farming. Those are manageable things.
Right.
OpenAI is dealing with these theoretical, emergency shutdown scenarios.
It's a company where the mission succeeding could mean the stock completely failing. Think of it like this for you listening. Imagine a drug company is legally required to stop selling a cure that makes billions because they find a tiny but lethal long-term side effect.
They'd have to do it.
They'd be legally compelled to sacrifice all that revenue for safety. That's the level of duty we're talking about.
So because investors can't influence these huge decisions, analysts are already pricing in what they're calling a governance discount.
Yes, and the estimates are somewhere between 15 and 25% off the total valuation. I mean, big institutions just won't pay full price for a stock where they have so little say. And you have to remember the chaos of the November 2023 board crisis.
Oh, yeah.
That history of instability is now permanently baked into this risk model.
So the governance alone puts this multi-billion-dollar anchor on their valuation. But okay, even if you can swallow that, you then hit the next hurdle. The sheer math of the capital they need.
And this is where the numbers just get mind-boggling. I mean, the revenue story is incredible.
It is. The top-line growth for 2026 is projected to be somewhere between, 12.7 and $20 billion. Just stunning growth.
The demand is absolutely there, no question.
That revenue story hides the number that's keeping everyone up at night. The cost.
Yeah.
The operating losses for 2026 are projected to be nearly $14 billion.
14 billion. I mean, just to put that in perspective for you, when Amazon went public, its losses were in the hundreds of millions. Uber was in the low single-digit billions. A $14 billion operating loss is. It's a whole other category.
And that's the cost of training the next-gen models, right? The successor to GPT-5, the O3 and O4 series, as they're called.
That's the compute cost. The capital expenditure, or CapEx, is just unprecedented. And it's not just about buying servers today, it's the long-term commitment.
You mean the Stargate project?
Exactly. The $100 billion Stargate data center project with Microsoft, that's a capital commitment that a private company just can't sustain forever.
Which is why an IPO feels almost mathematically necessary. At a $500 billion valuation, the world of private funding is just tapped out. The sovereign wealth funds, the big tech companies, they're already in.
So what does it all mean? It means the public markets are really the only place deep enough to handle these huge recurring $10 billion plus cash injections that they need for this infrastructure.
And you can't forget about the talent either. Keeping the best AI engineers, it's a war. And liquidity is the weapon.
For sure. The current system they have, these semi-annual tender offers, it's clunky. It's inefficient, creates tax headaches for employees. It's a retention problem. The gold standard is liquid RSUs, and you only get that with a public listing.
If you are enjoying what you're hearing today, we invite you to subscribe to the channel, leave a like, and tell us in the comments what topics you'd like us to cover next. In the description of this deep dive, you will find the PayPal link if you want to support this project. Your contribution helps us continue making content like this. We only ask for the cost of a coffee. Thank you for your support. Okay, let's get into the next big hurdle, which might be the weirdest thing I've ever seen in a potential S1 filing, the Microsoft AGI cliff.
It's a truly bizarre risk. I mean, it's a binary risk that investors just have never seen before, and it comes from that revised deal they made with Microsoft back in October 2025.
So lay out this terrifying paradox for us.
Okay, so the AGI cliff clause basically says that all of Microsoft's exclusive IP rights and their profit sharing, it all stops. It ceases the moment AGI is achieved.
Wait, so the company's ultimate success, creating general AI, is the trigger that automatically kills its most important partnership.
And reconfigures its entire revenue model overnight. Yes, investors are betting on success, but here, ultimate success triggers the contract to terminate.
And the process for declaring AGI has changed too, which is critical.
That's a huge point. It used to be just up to the OpenAI board, but now the declaration of AGI has to be verified by an independent expert panel, so they can't just delay it for business reasons.
So it's like the moment your team wins the World Series, you're forced to fire your star pitcher and lose your main stadium sponsor. Is that the analogy?
That's functionally what it is. And for an IPO prospectus, an S1 filing, that's a complete nightmare. It means the success of your main R&D goal immediately triggers the loss of your primary distribution channel, which is Azure.
Wow. And the competition is heating up too, which makes this even riskier.
What's fascinating is what this signals. The new agreement lets both companies pursue AGI on their own. It's why Microsoft is pouring money into its own models, like MAI-1, and partnering with competitors like Mistral.
They're hedging their bets.
They are, and for Wall Street, that reduces OpenAI's long-term competitive moat. A big part of the valuation is about long-term dominance, and this deal really complicates that story.
So, given this massive need for cash and what seems to be a huge market appetite, why hasn't this IPO happened yet? Let's sort of break down the push and the pull factors.
Well, the push factors are powerful. You've got the need for employee liquidity, that existential need for capital for things like Stargate and, validation pressure. Their biggest competitor, Anthropic, is rumored to be prepping a 2026 IPO at a $350 billion valuation.
So if your rival goes public, the pressure is on.
Immense pressure. But the forces holding it back, the pull factors, are also formidable, starting with the regulators.
The FTC and the DOJ.
Yep. They still have open investigations into the Microsoft deal, looking at it as a kind of disguised merger to get around antitrust rules. Filing an S1 would mean opening their books completely.
Giving regulators a whole lot of
A
ammunition.
ton. They'd be filing right into a political storm. And then there's the legal risk. The New York Times copyright lawsuit is entering a critical phase in 2026.
And that is not a small case.
Not at all. I mean, if the courts rule that training these models on copyrighted text is infringement on a massive scale, the potential liability for new shareholders would be uncalculable. You just cannot go public with that hanging over you.
And finally, there's the human factor, the culture. Sam Altman himself has said he has 0% interest in running a public company.
Right, because of that quarterly pressure.
Yeah.
It's totally at odds with the long-term secretive work of AGI safety research.
And yet, despite all that, the operational signals, they all point to getting ready.
They absolutely do. Hiring Sarah Fryer as CFO, she took Square and Block public. That's the clearest signal of IPO readiness you can send.
Yeah.
You bring in someone with her exact resume for one reason, to get your financials ready for public markets.
And the demand from those markets is it's insane. Goldman Sachs, Morgan Stanley, they're modeling valuations from $600 billion up to $1 trillion.
$1 trillion. And the secondary markets show demand is constantly outpacing supply. It proves that despite all these completely unique risks, the appetite for this asset is just insatiable.
Okay, so let's game this out. Based on the sources, what are the most plausible scenarios for them getting liquidity over the next year or two?
So scenario A, which analysts give about a 45% chance, making it the most likely, is an IPO of that dual structure in 2027.
Delayed a bit.
Delayed a bit, yeah. They go public as a PBC, the foundation keeps control with special shares, and the delay gives them time for revenue to scale up and hopefully get some of these legal issues sorted out.
Okay, what's scenario B?
Scenario B, about a 35% probability, is they just stay private for longer. They avoid the SEC by creating this sort of sophisticated private internal market funded by debt or more sovereign capital. They innovate financially, not just technically.
And the last one.
Scenario C, the outsider at 20%, is an operational spinoff. Basically, antitrust pressure forces them to split the company. The profitable parts, like ChatGPT and enterprise products, go public as a separate company.
And the core AGI research stays private in the foundation.
Exactly. It's a way to try and please both Wall Street and the regulators.
So our conclusion here is pretty clear. The IPO is a real possibility. It's almost a necessity, but it is not happening in the first half of this year. We're looking at a completely new kind of asset where, the duty to shareholders is intentionally put in second place.
Right. And if you're an investor thinking about this, you have to discount for three huge, unique risks. The governance risk from the foundation's control, the contractual risk of that AGI cliff, and the massive regulatory and legal risk that's still out there.
Which brings us to our final thought for you to chew on this weekend. Is OpenAI the ultimate test? The final test of whether the single largest value creation event in human history, the invention of AGI, can actually be captured and governed by financial tools that were designed for the industrial age.
And with that, we've reached the end of today's deep dive. We hope you enjoyed it, learned something new, and that you'll join us for the next one. Thank you very much, and we'll see you again very soon.
Thanks so much for joining us. Remember, you can find the link in the description if you want to help support the project. We really appreciate it. Have a fantastic weekend, everyone. Rest up, and we'll see you on Monday. Take care.